We entered into this week on extreme fear before seeing the markets eventually bouncing back. However, many people are still unclear about whether or not there will really be a recession coming in because the economic data that we have isn't really painting us a very clear picture. And because of that, the reversal in the stock market basically got people flat-footed and unsure how to position their portfolio. Because on one hand, some people are afraid that being all in into the stock market will basically see their portfolio wiped out during the recession. But at the same time, the fear of actually sitting on the sidelines if there's no recession and seeing the markets keep going up make people afraid of missing out on these potential gains. So how exactly should you invest and position your portfolio right now moving forward when you're not sure whether or not there's a recession? So the last time you left me, I basically had 5 massively underwater Intel puts. And then you add on top of that the recession fears that we actually talked about in this video and the unwinding of the Japanese carry trade. We really got ourselves into a bit of a pickle. And if you're not sure of what is this carry trade that we're talking about, here is a brief summary. So basically what we're actually seeing with the yen carry trade, right, is basically investors are going to Japan, they're actually borrowing their yen at a lower interest rate, which is basically what it has been in the last couple of years, investing it into assets with higher returns and then basically paying off the loan eventually. So basically what you're actually seeing is that people going to Japan, and because the yen is very low, they borrow the yen, they bring it back into companies like in the USA, and then maybe you invest in things like Tesla and then things like Apple, right? And then usually if the stock price goes up, right, you borrow $100 yen, you return $100 yen, no big deal. The problem is when the Bank of Japan actually raised interest rates, right, the yen actually strengthened against the dollar. So that means instead of having to return $100 as usual, suddenly people were having to return maybe $110, $120, right, instead of $100. So that is no problem if the shares that they're buying in the States are actually doing well. So imagine, right, if I borrow $100, or let's say I borrow $200 yen to go and buy maybe Tesla for $200, right? And then so over the last couple of weeks, actually Tesla went up to 270. And then if during that period of time, you have to pay back $210 in yen, that's no problem, right? Because after 270, you minus off basically having to pay back the yen, maybe $220, you still are left with a profit of about $50. Now, that's not a problem because you're still profitable. However, a lot of traders don't want that. They're worried that the yen keeps going up and then the profit gets less and less, so they are rushing to cut the trade. Now, another issue that we actually experience is that, let's say you buy, you actually borrowed the yen for $200 and then you actually bought Tesla for $200. And then now, over the last couple of days, actually Tesla dropped below $200. So now your Tesla shares are worth $195. Then the yen that you borrowed, now you need to return is $220. And now not only are you down $5 on your Tesla shares, you're also down $20 on the loan that you have to pay back on the yen. And because of that, people actually start to panic, and then people actually want to take out some of their assets and then basically try and pay off that. So that's what we call the unwinding of the Japanese carry trade. And then the BOJ basically told us, hey guys, you know what, relax, we are not going to raise interest rates so far, so you do not have to worry. And so because of that, the yen basically started to fall, markets started to rally, and the whole story is over, right? I mean, right? Isn't it the end of the story? Not quite. There's still another part to it, but to understand the last part of this story, we have to look at what's happening in the US. When everybody was freaking out over the unwinding of the Japanese carry trade, a lot of people in the US were saying, you know what, our Fed is going to come and bail us out, only to realize that the Federal Reserve will not bail them out even if the stock market crashes. Because the Federal Reserve has a dual mandate, and part of that dual mandate does not include stock price movement. You know what? But if stocks start to go down, companies will have to end up firing people, and that's basically a self-fulfilling prophecy of causing a recession. Won't the Federal Reserve care about that? Yes, they will care when a recession happens. However, it's not the Federal Reserve's job to basically predict a recession based on the stock price movement. They look at economic data, and when we look at the economic data, it's basically a mixed bag. It doesn't really tell us much. You see, on Tuesday or on Monday, we basically got pretty good PMI, and on Thursday, jobless claims came in lower than expected. So if you're just looking at the data, the economy looks fine on the surface. So to say that by looking at all these data, a recession is a natural conclusion is a little bit too fast and jumping the gun. And I think the most important thing above everything else is for the Fed to basically keep their sense of credibility among investors. See, they have long gone along with this narrative that, you know what, we are not basically sensitive to price movement, we only look at economic data. And if they were to cut rates because of price movement, basically it tells the public that, you know what, the Federal Reserve is panicking. They probably would have lost control of the situation behind the scenes, and they're just not telling us. And that kind of fear that it creates basically can be worse than whatever good effects that we actually feel from a 25 BP cut. That is when real panic in the markets will happen, and I think that is the last thing they want. So I highly doubt that the Federal Reserve is going to jump in with an emergency cut, even if we see the continuation of the Japanese carry trade unwinding. See, the problem in the US, right, it's not so much about the economic data coming in, because a lot of this economic data is actually backwards looking. What's actually concerning investors and some of these bigger institutions, is basically when you actually look at the earnings call, companies and CEOs are basically telling you, you know what, we had a good Q1, Q2, but their concern is moving into Q3 and Q4, where some of the companies actually lowered guidance. Now, going into the past week, right, we actually noticed that stocks like SMCI has actually fallen by more than 60% over the last 3 to 4 months, and in their recent earnings call, they actually tried to address some of the concerns people had about margin compression in the chip sector. However, I don't think they fully convinced investors, because their EPS actually came in at $6.25, missed expectations of $8.25 by a full $2, And then not only that, their gross margin contracted to 11% from 14% expected, and their operating margin also missed at 7.8% versus 10% a year ago, which basically left investors more skeptical than anything. But that's not all. Disney actually reported a surprise profit in their streaming segment. However, their stock actually still sold off because I think investors were a little bit concerned by the softer guidance when it comes to their theme parks. Now, to understand Disney's business, you have to understand that the theme parks is part of this bigger segment of their business called experiences. Basically, what is included in there are things like certain attractions and even their Disney cruise lines. So when people actually ask about their soft guidance when it comes to theme parks and things like that, they actually, brushed it off and said that this is just a few quarters, and so that is something that we really need to keep an eye on. However, in that same sentence, they actually told us that they expect the profitability for this segment experiences to actually decrease in the rest of 2024 and 2025, which I guess spooked investors even more. So if I look at the earnings call, this is actually what they say. Now we keep in mind that we do have some expenses attached to our ships coming in, and that will affect us a bit in 24 and 25. But overall, I'll call this just a bit of a slowdown, and that's being more than offset by the entertainment business. So I guess in terms of business management, to them, they are not too concerned about it. However, the slowdown in guidance does tell us that there's a weaker consumer demand. And I think when investors look at it, that is something that they are concerned about as well. To me, from the way I look at it, if the cost associated with running these cruises actually eat into their margin, it means that there's lesser demand for these cruises in the first place, which is why the margin would contract at all. So basically, that is why we see their stock is actually down over 30% in the last couple of months. If you look at another company, also a travel-related company, Airbnb, they actually show weaker consumer demand because consumers, they basically tell us, are likely to book their holidays only weeks in advance rather than months in advance, which was what was previously the norm. However, another thing that basically is against Airbnb, right, is because in the last couple of years, there was a lot of pent-up travel demand, which is why you see a lot of these travel stocks actually do very well. However, now they're comparing against higher comps in the last couple of years, so which is why their growth forecast may not look as good going forward, and which is why some of these valuations are getting compressed. If you look deeper into the earnings call, they actually tell us that, however, we are seeing shorter lead times globally, which is actually what we mentioned, and some signs of slowing demand from the US gas, and then basically they say in Q3, their outlook incorporate these recent trends. So, which is why I guess it also spooked investors again in the sense when it comes to Airbnb earnings, which is why they're down after they reported earnings. And I think despite everything I said about, having tough comps in the last couple of years, right, this slowdown in consumer demand is there for us to see in both Disney and Airbnb's earnings. And I think another thing for me that was quite telling in the Airbnb earnings is that when they were asked about, Q4 guidance, 2025 guidance, they were hesitant in actually giving a very direct answer. And so to me, that doesn't really fill me with optimism, because to me, it feels like, they kind of know something, but they don't really want to say it because they're not very sure yet, which is kind of the sense that we're getting from the economic data. Are we really going to a recession? Nobody really seems to know. Economic data is also not very clear at the moment. So when we look at this fourth company, Elf Beauty, the stock is basically down 15% after good earnings, which is kind of symptomatic of the stock market at the moment. Like I was mentioning in my last couple of videos, right, valuations are now a little bit stretched in some sectors. Basically, stocks are priced for perfection, which means that if your earnings are not perfect, that means getting a triple beat and things like that, people are definitely going to punish your stock, which is exactly what we saw happen with Elf. So basically what happened with Elf is basically their makeup brand. They actually target the day-to-day consumer with cheaper, more affordable makeups. And basically what we actually see is that Elf is telling us that, we're going to increase our marketing spend going forward to drive revenue growth. Now, when you increase your marketing spend to tell people that, hey, I'm increasing marketing to drive revenue growth, we expect revenue growth to be significant. However, their guidance for revenue growth in the coming quarter still actually missed expectations. So you're spending more on marketing and making revenues lower than what people tend to expect. So I think that is why investors are a little bit spooked. And I think another concern when it comes to increased marketing costs is basically lower profitability. Because now their EBITDA is about 28%, but once they increase their marketing spend, they actually see EBITDA compressing to the low teens, which is again something that is concerning to investors. And for me personally, when I see a company spending so much on marketing and not generating the revenue growth that is basically associated with the marketing cost, it gets me a little bit concerned whether or not this is just a one-time, two-time thing over a couple of quarters just to tide them over, or is this a larger trend? Because especially I think what's concerning to me is because their target audience, right, are the day-to-day consumers, people that tend to buy cheaper, more affordable makeup, right? So if we do enter into a recession, then there's naturally going to be slower demand. So are they ramping up marketing just to, in a sense, paper over the cracks and not talk about this slower demand? So that's something that we have to look out for in the coming quarters, because if we do enter into a recession, then it is the day-to-day consumer that will be more likely to cut back on spending, because the higher net worth, the more affluent crowd have a little bit more of a buffer and they will not be as affected during a recession. So after listening to all these earnings, I think one thing that we can glean for this is that there's a potential weakening of the consumer, definitely a bit lowering of demand, which usually means companies having to cut costs, lay off staff in order to maintain their profitability. And when people lose their jobs, right, they tend to spend less, which further lowers demand, and then it's just a self-fulfilling prophecy at that point in time, which may end up causing a recession. Whether or not it will actually happen, we don't really know, because like I said, economic data is still not very clear at the moment. Some data has come in good, some data has actually shown softness in the economic markets, and everything is still up in the air at the moment. So ladies and gentlemen, if you are afraid of a recession upcoming, it's all the more important for you to hit the like and subscribe button, because as you look at me make sense of some of these data, hopefully that will give you another perspective, a different kind of insights as you manage your own portfolio. Thank you for your time, and back to the video. This is where we round up the story of the carry trade, because Reuters actually tell us, you know what, the unwinding of the carry trade isn't fully over. There's still very easily 50 to 60% left to unwind, with the Federal Reserve actually telling us, hey, we are not going to cut rates. The unwinding of the Japanese carry trade still to come. We might have pain ahead of us if the yen starts to spike again. But didn't the BOJ just tell us that they're not going to cut rates anymore? So why are we afraid that the yen spikes again? You see, very simple. The BOJ does not have to do anything, but as the Federal Reserve starts to lower the US interest rates, the strength of the US dollar will depreciate against the yen, and basically the same thing happens. So instead of raising the interest rates of the yen, you're decreasing the interest rate of the US dollar to the same effect. And this time round, we already know the Federal Reserve basically has told us we will not do an emergency cut. They have just proven themselves over the last week, and basically investors know that moving forward. So now the thing that everybody has been looking forward to, the Federal Reserve cutting interest rates, may end up causing, well, some instability in the markets. So that's why investors are looking at it and everybody's like, oh, oh, and you know what? As a cherry on top, we're not very sure whether Iran is going to attack Israel, how the whole conflict in the Middle East is going to turn out, and the possible ramifications on that. And that's exactly where we find ourselves today. Now, I think for newer investors, right, if you hear about things like recession, and then this weird term about the Japanese carry trade unwinding, right, it can get very, very confusing. A little bit fearful because you're not too sure what happens, because you actually heard that, hey, a lot of people actually can lose all their life savings in the stock markets and things like that. So I'm here to actually tell you, don't worry, all of that is not going to happen. Just listen to what I have to say. So basically what I'm going to do is I'm going to address how you can actually position your portfolio going forward. There are basically usually only two types of people in the stock markets. And so basically I'm going to tell you about these two types of people and three different strategies that they can do. Now, the first type of people, right, are people that dollar cost average every single month into the stock market diligently. You don't actually pick your own stocks. You probably just maybe buy one or two mega caps like Apple, Amazon, Microsoft, and then you just buy some index funds. So very simple stuff. You dollar cost average every single month there. So for these people, right, the plan is actually very simple. You never, ever, ever, ever stop dollar cost averaging, okay? Even in a recession, you keep dollar cost averaging. Now, what I want you to do is try and, store some extra cash at the side. And then what you're going to do with this extra cash, right, is that when you look at the charts of the companies or of the index funds that you're buying, look at their 52-week high. It means in the last 52 weeks, when is the highest price point? And then you actually make certain markings. I want you to make a marking 10% down, 15% down, and 20% down. Means, for example, if you buy a stock at $100, right? So you 10% down, it means at $90, and then you 15% down will be at $85, 20% down will be at $80 and things like that. So you actually know the price point. Now, what if the stock never ever drops to your 10% price point of $90? You keep dollar cost averaging as normal, nothing changes. However, once the stock drops to $90, you put in your normal dollar cost averaging amount, and then you add on your first pile of cash. Now, what if it drops to $85, the 15% down price point, you dollar cost average, first wad of cash, second stash of cash, all in already. And then if it drops even more to the 80% price point, this is, listen, this is for people who are investing in index funds. I'm not talking about people who are picking companies, index funds only, those that are doing dollar cost average. Then you might want to even double or even triple your investment just for that month. I don't care if you probably have to go and eat buy mean bao that month. Sorry, eat 白面包 for international audience means eat white bread. Okay, basically you just scrimp and save. You don't take Grab, don't take Uber to work. You walk to work, things like that. You wake up at 5 a.m. so you can walk to work. Basically, try and find ways to put a bigger pile of money together and to go a little bit more heavily into the market that particular 1 or 2 months lah. And basically that's what you need to do. Don't stop dollar cost averaging. Keep doing the same. If you never ever hit those price points, nothing changes for you. Life as per usual, right? Carry on just dollar cost averaging. But the second group of people, right, who are people that actually pick their own stocks. If you're like me, you can actually do the first strategy, which I was doing it previously, I can tell you it is a very inefficient strategy, but it is the easiest strategy. So this is only for people who pick your own stocks, you're very confident in your research. All you have to do is hold, do nothing, that was the word holder, HODL. Yeah, I'm going to put the word here. Right, all you have to do, hold. Eyes of steel, no, what, nerves of steel, ice in your veins, that sort of thing. That's all you have to do. You actually have to hold if you are very certain about the research that you have done on your companies. Because for me, I don't hold many companies. I'm very sure about the companies that I hold, and then basically, if you're very certain in your research, that is something that is going to help you, lah. Because in a recession, chances are even your core holdings, right, are going to be severely affected. And then when they are very affected, the price basically will go all the way down. But what you actually will want to notice at this point in time is that when the price goes down, as long as the business is going up, then you are very safe. You know that you're holding on to a good company and you can keep holding and do nothing about it. For people who are investing in individual companies, another thing you might want to consider doing is to consolidate your position, which means that you look at your portfolio, you reanalyze which are the companies that you have the highest conviction in, and basically companies that you maybe do not have so high conviction in. Because I know, at least for myself, right, when the market is good, when everything is doing well, I tend to like to have a little bit of like teaser positions here and there in companies that I'm maybe 70-80% convicted in, that I'm still building my conviction, still building my understanding of the company in. And during this period of time when we're entering into recession, when there's a little bit of uncertainty or volatility in the markets, it might be a good time for you to just take some profits, or maybe cut some losses here and there, such that you actually build up a pile of cash. And what you want to do with this pile of cash is that during the recession, if we really enter into a recession, that's when you actually deploy that cash into your core, 3 or 4 holdings. And then as the economy recovers, your 3 or 4 core holdings will recover together with the economy and basically make up for any opportunity cost that you have lost, basically staying invested in your other stocks. However, doing this strategy does come with a risk. And I do think that, right, sometimes that the risk is twofold. So the first risk that I want to talk about, right, is basically that if we do enter in a recession, but maybe the recession is not as bad as people expected, I won't be surprised to actually see the stock market continue to go up, continue to rally, even though the economy is in a very slight recession, because it's not as bad as people expected, so stocks still continue to go up. And if that's the case, then the money that you actually set aside really become opportunity cost, because you may miss the rally. If we do enter into a recession, not everything is a bed of roses, because basically if we enter into a recession, stock prices will fall, and chances are, some people want to bottom feed. I want to wait. And that's what happened to me previously on some companies that I was holding. I was trying to wait for the bottom. And sometimes when the price gets so low and hold at a low point for a long period of time, right, you get very skeptical of every single move up. You keep telling yourself, you know what, this is not a real move. This is just a dead cat bounce. It's going to come back down again. And eventually, when it's not a dead cat bounce, you really miss the move and you end up finding yourself chasing after the stock. So basically, if you keep this pile of money at the side, you need to have a very objective plan of certain price points that you want to deploy the cash. And if you don't catch the bottom, that is perfectly fine. Because if you try to catch the bottom, you become very emotional about it. Chances are you'll miss a good investing opportunity. So basically, if you're someone that is emotional, you're someone who basically haven't built up that psychology of investing yet, then you might want to consider not taking out so much cash and basically just staying invested and dollar cost averaging into the stock market, basically the first 2 strategies that we talked about. Because the last thing I want is for you to tell me, you know what, I'm consolidating my portfolio, so I'm selling this bunch of positions, have the cash on the side, and then not deploy the cash in a recession when your core holdings are actually down. So you need to go into this with a plan. You need to be very objective, and that means that when your core holdings reach certain price point, you will deploy parts of that money. Don't all one shot everything go in. Okay, so that's the first thing. Second thing, risk management, which means that you just have to tell yourself, sometimes I'm just making the decision, the best decision I can make with the information I have. Sometimes in investing, you just have to hold your hands up and admit that, my understanding, my thesis may have been wrong. So basically, like what I said, maybe I expected a recession. The recession came. It wasn't as bad as I expected. It wasn't as bad as the markets expected. And the market started to rally. And the last thing I want is for us to basically sit at the sidelines and watch the market rally and never ever come back in. So basically, what you want to do, apart from planning when to enter in as the stock market starts to fall, also plan when to re-enter if you actually realize that, hey, you know what, I may be wrong here. And I just, instead of basically, fighting with your ego and say, I'm not going to enter, the drop is going to come, things like that, you actually tell yourself that, hey, once the market reaches certain threshold, even if it means averaging up my cost basis, it is more important for me to stay invested in the long term than to get this one particular call right. Because in your whole investing journey, there are calls that you'll get right, there will be calls that you get wrong, and the whole game is basically about learning from your mistakes such that moving forward, you do not make the same mistakes again. And honestly, right, averaging up your cost basis in a very good company, like if you're really telling me that these 3 to 4 companies are your highest conviction companies, right, then averaging up your cost basis shouldn't be a problem. Because imagine the people people buying Apple back in 2010, they're not going to care whether or not Apple is 40, 50, 60, $70 back in 2010. It may look like a big price difference at that point in time, but look at where Apple is today. So that is the same kind of mindset I want us to have when we invest, that we invest only for the long term, and we only take certain strategic moves to position ourselves to take advantage of certain short-term volatility. Our mindset when it comes to investing has to always be long-term, and to understand that, you know what, as long as I make more right decisions than wrong decisions in the long term, I will be fine. And if that is not something you can handle, like I said, there's always the first two strategies of dollar cost averaging, of just staying invested and not doing anything, and just keep doing your fundamental research and holding on to the fact that your business is growing. So let's talk from a high-level overview, how do we position the portfolio? Because for a more detailed breakdown, you have to wait for our video tomorrow on the 13th of August. So basically, if I already produced that video, I'm going to link it over here. Otherwise, you just have to come back to the channel on the 13th of August. But on a high level, one of the first things I did was to actually trim PayPal. Now, I have to put a disclaimer here. I think PayPal is a good company, and as you can see over here, I still have exposure to it in another portfolio via 2026 call options. Now, why did I choose to trim PayPal in this portfolio? Very simple reason. I think PayPal is a turnaround company, which in of itself has a little bit of risk associated with it, and you throw in the possibility of a recession. Being a payments company, I think they are a company that will get affected by a recession, like if we do see a weaker consumer. So it's one of those names that I'm, maybe 70, 80% convicted of, but holding it into a possible recession is not really for me. I think this is easily $80 to $100 kind of stock if everything goes well. However, because it's such a small position in my portfolio, it doesn't make any sense for me to hold the $1,100 there. I'd rather take out the money, use it as collateral and sell cash secured puts, and then if a recession does hit, I'll double down into higher conviction plays like SoFi. So as you can see, I've also increased my exposure to SoFi by selling more puts at $8 for January 2025, meaning that I'll buy a total of 1,700 SoFi shares at $8 by January 2025, which is exactly what I said to do, trim your lower conviction and then position yourself to allocate into higher conviction companies. I know that at this point, it may seem that the whole portfolio is going into SoFi. I don't expect all of these contracts to be assigned. If it does, then I will basically roll some of it out like what I've done for Intel. Finally, I have this Intel position where I closed 4 of the 5 Intel puts because I didn't want to hold a second turnaround play going into a recession. And I think personally, in my opinion, I do think that Intel is a more risky turnaround play compared to PayPal. I have a much more confidence in the management of PayPal. I could have closed all 5 puts, but I decided to leave one just so that I can show how you can actually use the wheel strategy to get out of a losing position profitably. Right. Additionally, I do think that my thesis for Intel is still intact. It's just that I do not want to have that much exposure. I don't mind holding these 1,000 shares at $29. I have no worries that Intel are going to go bankrupt in a recession. So basically, that is how we end up with these 100 Intel shares. We basically got assigned them, right? But to have a more detailed understanding of each of these decisions, you have to watch this video over here, and I'll see you in the next one.